A mystery whale props up the bond market. Bitcoin hits new highs and the Dow takes a wild ride. Who's really buying America's debt and where is this liquidity coming from? All this and more on today's After Hours.
Hello, Tom.
Welcome everyone to After Hours for May 23rd, 2025. I'm one of your hosts, Tom Hartman, joined as ever with Peter Bad Guru Hartman. After Hours is TradersPost weekly commentary show where we go over the market news for the week past, looking at the week ahead. This week, it's all about the bond market and the liquidity that has shown up out of the blue. But before we get to all the good stuff of the last week, I like to turn to Peter and ask, how are you doing?
I am doing swell, doing
That's
great.
great. So, what I wanted to no, I'm just kidding.
Having fun vibe
Peter,
coding. I sent you what was that, Taskmaster AI, which very
Taskmaster
promising.
AI, exactly. I'm actually pretty fascinated by it. Have you used it yet?
I tried it. I think that thing is made for projects that are far more complex than mine. So I kept having to try to dumb it down, but I'm gonna do another attempt with it today.
Well, I was using on Blueprint episodes. We've been doing what is it?
Project
Planner
rules.
executor mode,
Yeah.
right? So in using Cursor AI, we have this process that we got from online where you're able to separate tasks into planner mode and executor mode. Very nice to be able to keep like a certain type of memory within your system and then move forward and develop from there. Taskmaster AI is that on crack because what it's doing is basically it has a whole system in order to like keep track of the tasks and break down the project to tasks in a PRD file and then just essentially iterate through that until you get to the end. So I've basically now just switched my workflow to that, and this weekend I'm going to be building out on that platform. But it should make it should make our blueprints that much more exciting.
That's what I'm hoping for, yeah.
Um, yeah, I really want to prepare a standard like something like this, but for PineScript development or for because there's all kinds of libraries and tools for developing automated strategies and backtesting and forward testing and all that. That'd be nice to standardize or to provide a framework where people could just like plug and play into it, especially if you're not coding focused. So, I mean, our lives have been all about vibe coding, vibe writing, vibe marketing this whole time over the last few months, and it's just upgraded now with some of the new things that have come onto the market. So you're right, that has been pretty interesting.
What have you
What do
been up
you?
to?
Well, for me, it's all about. A few weeks ago, you remember we did on Blueprint a backtest and solution for strategies, and that sort of sent me down the rabbit hole because my knowledge of backtesting was sort of like fly by the seat of my pants sort of thing, because I was like, well, I'll backtest in the market. I'll just run it with live money and then I'll know. I won't have to worry if my slippage model is correct. I won't have to worry about calculating commissions and factoring all that in because if I lose money, I know it wasn't worthwhile. I don't have to see if it's good for the environment that I'm in and I don't have to worry about any of that. But then the sort of trading that I do, I like to swing for the fences on asymmetrical bets. And so oftentimes it's not like easily reproducible. So I didn't really care. But now that I'm developing more systems I'm trying to be helpful to the Traders Post community. Now I would be more diligent about it. I see some of the gains that people have been having in all the trading bot sessions interviews that Mike is doing with Rebecca Trades, with Tyler Goodell, with I'm jealous. I'm jealous of the profits that they're making, and I want to make better profits. I'm like, okay, I'll make better systems and scale them out that way.
And what do you think about prop firms? Was there a period where you were really into prop firms? I mean, do you still do them?
It's just that they're mostly like the ones that I know about are mostly for U.S. users. So the prop firms that I can use require Well, I guess I could spend more time on them. It's just I swing for the fences, and so I'm going to blow out an account. I've blown out all my accounts that I've ever had on
Yeah, but
prop
can't
firms
it teach
because
you to be diligent?
I don't care.
Uh,
In fact, when I hear about all these different interviews, they just go like, if you don't have the personality that would lend itself to the guide rails that the prop firm account gives you, then you're not going to be able to do it. Like, for example, some people will trade options and they'll trade complex structures and multiple different legs and different calendar spreads in order to take advantage of an edge that they have in trading volatility for the next 3 months. I will place a bet on a long shot option 2 years out and forget about it until it pays off. For it, if it doesn't pay off, I don't care. I already bought the ticket. I don't even, if the money shows up in my account, great. If it doesn't, I never think about it again. And so I put all my effort into understanding, hey, where's the asymmetrical bet? Where's the 10-1 odds that I think is mispriced? And put all my focus on that. What's the trade expression? And then win that way. Now that's been great for me, right? You've heard some of the bets I've made that I've, you earn a huge amount of money all at once, and it might take a year and a half to pay off. But like, I like that because I'm rewarded for the information that I have versus the structure of the actual trade expression.
Why not just automate the prop firm stuff and just see if you can just do an automated strategy so you don't have to worry about it?
Yeah, that's the problem for the automation part for the platforms that will allow for that sort of integration. They're not Canadian focused, so I can't use them.
I see.
We'll see. Peter, I know you're pretty up to date on the bond market. You spend a lot of time looking at bonds to see how pension funds and sovereign wealth funds and the government finances themselves. And so I know you have a lot to say on the subject, but if you'll forgive me, I just want to give people a recap here of what's
All
been
right.
going on over the last week.
Right.
2 days ago, bond auction, 20-year US Treasuries. And
20.
basically, this, sorry, go ahead.
20-year.
20-year.
Well, normally we talk about 2, 5, 10. I don't think I've ever heard of.
Correct.
Huh.
Yes. So 20-year has to do with stuff like pension funds, um, mortgages, long-term refinancing, and government debt that's financed on the long end. So the idea here is that, just as a recap for people, you have the value of the bond, like how much it costs to actually buy the bond, and the interest rate, right? The rate for the bond. The higher the interest rate, the lower the price for the bond. And when bond yields come down, the value of the bond goes up. The reason for that is clear. The interest is how much the bond seller, in this case, the US government, is paying you to lend them money. So, hey, you lend us $100,000, we'll give you 3% at the end of your every 6 months or whatever for the coupon for the bond on for the end until the end of the bond. So that means you lend it for 20 years. In 20 years' time, you'll get that $100,000 back plus the 3%. And if they can't, if at 3% that's not a good enough deal for you, you're like, ah, yeah, you're gonna lock away for 3%, but inflation's at 3%, so I'm gonna end up just getting my money back. Some people like that, some people don't. So there's a different demand for the actual bond, and so if you see the interest rate go up, it means that the government has to offer higher interest rates to solicit your money, right? So this usually means that they're either basically there's the higher interest rates mean that for some reason, either good or bad, people don't want to lend at the rates you were giving. They want you to give a better price. So the 20
Wait,
year happened.
just before you do that, can I ask you a question?
Yeah.
Why can't the government, instead of trying to incentivize you by, higher interest rates, just really slam on, like, pump inflation so that if you don't put your money in bonds, the inflation will eat you out?
So remember, inflation is the amount of money circulating within the system.
Or purchasing power, or do something to make it so your purchasing power goes down, or what, like you put it into bonds to guard against you losing the value of your money, right?
The purchasing power of your money.
So if they
Yes.
destroy the purchasing power of your money, that will
Yeah.
make people fly to safety.
Well, they do that. They do debase your currency so that you fly to safety. That's already how the system works.
Oh, I see. Okay, never mind. Go ahead.
Because otherwise you just save your money. Why would you even bother
Right.
lending, give the money? So no, because they debase the currency debasement is different than inflation. Currency debasement is what you see
Right.
like in
Okay.
the stock market and real estate and whatever, where the value of the money is going down, but it's not directly inflationary in the way that people normally understand inflation. But essentially, so in this case, you would imagine that yields were at like zero or close to zero for like 15 years now, ever since the global financial crisis. But obviously, we had the inflation rise. Once last time since the 1970s, we had this level of inflation, and so we end up in a situation where we are interest rates were, let's say, at 3 to 4%. Um, the auction. What happens at the auction? What's interesting is that's the issuance, the new issuance of the bonds, where the government's trying to raise money, and the interest rate that the auction is gets at lets you know if we are trending up or down on interest rates. One of the ways you could trend up and down. And so the 20-year went up to 20%. Oh, sorry, 5% on the 20-year. That means it's the highest we've
5%.
had so far on the 20-year bond, and people are basically the buyers were saying you need to give me 5% or more on the bond on average, or I'm not buying this bond. I'm not lending you
Wow.
this money.
Wow.
Um, so that in itself is amazing. Now, what happened on the 20-year, which is interesting. The different tenors for the bonds are different. The 2-year is for like short-term funding, collateral, on-the-run stuff for hedge funds and market makers and stuff like that. Whereas long-term rates are for longer duration stuff, like I said, mortgages, pension funds, and blah blah, so on and so forth. And the 10 years, that happy middle between the 10-year and the 2-year and the 30-year, where it's just long enough to be long, but just short enough to be short, right? So if a bank or a business wants to finance anything, they might finance at the 5 to 10 year rate, so they're not locked into a specific one. They could always like roll their debt within a few years or within 10 years. Okay. So the liquidity, the amount of people who want the 20-year is not as much as 10, not as much as the 5, not as much as the 2. You could imagine that it's further out. Who wants to lend their money further out? People who don't need their money now, which is less and less people.
But wait,
Uh,
if that includes pension funds, et cetera, doesn't that encapsulate more people?
it's not nearly as much as short term.
Really?
Yes, not
Okay.
nearly as much.
All right.
It's more money, but less demand, less people want it. So the pension fund might want billions of dollars,
Right.
whereas you and your investment account might want to buy, $10,000 worth of a bond. They're going to buy billions, and the bond market's trillions of dollars. It's just the number of buyers.
Gotcha.
Okay, bond yields went up to 20%. The 20-year went up to 5%, which is high. Because if it's 5% on the 20-year, you can imagine that when the bank is lending out or when mortgage rates are happening or whatever, it's going to be higher than that. I think mortgage rates went up to 7% because they need some sort of spread in order to make money on lending out. The banks are not going to lend it out, or whoever's going to lend out money, who's using the 20-year as part of their funding mechanism, isn't going to do it at the same rate that they got the bond. They're going to give a premium on that. So it has this domino effect throughout the market. But what's interesting, so that caused like a volatility shock. 5%, the 20-year went up to, caused a volatility shock. People were like, whoa, what's going on? We're used to the world buying our bonds. Why are they not buying the bonds? They don't want it at 4%. They don't want it at 4.5%. They want it at 5%. And what does that portend for the future? Those bonds, when they're purchased by, and this is what's so crazy. There's a secondary market. So that's the initial issuer, like Rolex putting out their watches. You get it right away, and then you can sell it on the secondary market. And in the secondary market, a mystery buyer came in for billions, I think like $16 billion worth, to buy bonds and lower the price. So on the secondary market, if there's more demand than there was at the auction, the interest rates will come down. Because, anyways, that's how these markets work. Interest rates come down. So people are like, who's this mystery buyer in the bond market that bought $16 billion worth of Treasury bonds, 20-year Treasury bonds. Who wants that?
The
Now, I
country.
thought to myself, I'm used to the crypto world where it's like, well, let's just look at who bought the bonds.
Right.
No way to know.
Oh my God. It's not a country?
There's no way to know.
I mean, there's no way to know. 16 billion, you can move 16 billion, then there's no way to know.
Correct. The bond market is the largest market on the
There's got to
planet.
be some bank whose balance sheet has gone down by 16 billion.
Yeah, but they don't have to say who.
Look,
So primary dealers, certain financial institutions are required to purchase bonds in the United States to operate as part of the things. One of the transmission mechanisms for monetary policy within any system. So they're called primary dealers. They buy it, and then they sort of like authorized dealers for Rolex watches. They buy it, and then they can sell it to other people. But because of that, they don't need to tell who they're selling it to. Could be other central banks, could be sovereign wealth funds, it could be hedge funds, it could be all kinds of, so there's all kinds of speculation. But the way that I see it, why wouldn't it be the Fed? The Fed has two mandates. Do you remember what those two mandates are?
low employment,
No,
high employment, full employment,
yeah.
and I forget the other one.
Stable prices, especially in the bond market. So if you had this volatility shock of prices within the bond market, and then the next day after the auction, someone comes in to buy billions and billions of dollars worth, then why wouldn't that be the Fed?
That's QE?
It's a type of QE.
You
Why
said
wouldn't that be the Fed?
You told me one time they always find ways. The Fed always find ways to put
Always will
liquidity.
find a way. Always will find a way. The government and the Fed, all central banks and their governments, want charts to go up and to the right. Don't listen to what they say. They need it to go up and to the right because the whole system that we're in, the financial system they're in, is a debt-based economy, and the debt is based on the value of the collateral. So if your collateral goes down in value, and you have to mark to market that collateral, that means your balance sheet has less value. Your liabilities don't go down. Your liabilities stay at the same price. You're screwed. So what? So like that to me seems far more likely that the Fed is one who did it than some mysterious hedge funds came in the next day, not the day of the auction, where is the day they're supposed to buy all the stuff, the day after big shot. And you might be like, Tom, aren't there mystery buyers all the time for large amounts for these bond markets? No. No. So what's going on? All right, so I wanted to share this over here, just a post, just recapping some of the things, and I thought of some interesting things inside of it that would need to be that could be addressed there. All right, so first up, this is from Stock Market News and Investing on X. Yesterday, $16 billion 20-year Treasury bond auction failed badly. Demand was weak, yields surged over 5%, and markets tanked. This wasn't a routine hiccup. It's a wake-up call for the Trump administration. Here's what's happening and what they must do next. At 1 p.m., they issued the 20-year bond. The yields jumped up to 5.12%. 10-year went to 4.6. Dow fell. As you can imagine, there was a shock within the financial markets. Let's zoom out. What's happening is deeper than just one auction. Let me zoom in here. Make it easier for you guys. The U.S. government is issuing record levels of debt just as the Federal Reserve has stepped back from being a buyer, theoretically. This is why we're seeing weak auctions and rising yields. But why did the Fed step back? Number of reasons why they said step back, QE, QT, we don't have to go through all that. So right now, the U.S. Treasury needs to borrow more than ever, but the Fed, its biggest historical buyer, is out of the game, right? So you might think to yourself, well, the Fed's not buying it. Well, they're not buying it publicly, right? If the Fed was buying it before, it's because they wanted to have liquidity and stability and fund the government and do all the stuff they're supposed to be doing. Why would they stop? It seems more likely that they just don't want people to know how much they're buying.
Why?
Because that means there are no buyers.
Yeah, I guess so.
which is problematic.
I've experienced this when it came to selling chocolate as kids, door to door. And then you got to hit those numbers in order to win the prize. And then you realize I'm not selling enough chocolates. So then you got to get your like uncle or something to buy a bunch of chocolates so you can goose those numbers up.
Correct. Now, here's the thing that I find strange. No need to switch. What I find strange is when interest rates are low, 0% interest rates, this is a sign of an unhealthy economy. Correct? Interest rates are not supposed to be at 0%.
Right. I mean,
You're not supposed to be able to, large institutions borrow money at nothing or near nothing. That doesn't make any sense. Right? In fact, when interest rates are at 0%, it's the large players who get 0% interest. You and I don't get a 0% interest rate. We get nothing. Right? So they talked about free money over the last 15 years. Yeah, it's free money for big players. Why? Because if you are Apple, they're not worried that Apple's not going to be able to pay back a bond. But if you're some mid-level company and the economy is doing poorly, they are worried that you're not going to be able to pay back that bond, right? So they don't lend to you. But if the economy is doing poorly and all the lenders want to lend to the bigger players, they have to outbid each other to get that big player to get their loan. Remember, the interest rate for a bond is the price that you're paying, right? That's what you're if you're borrowing that. If Apple borrows $10 billion, they have to at an interest rate of 2%, they have to pay back the $10 billion plus 2%. And the bank wants that 2%. That's where they're making the extra money. But if there's multiple entities who are bidding for Apple to get their bonds, then that guy says 2%, this one says 1.9, the other one says 1.8, 1.7, 1.6, 1.5, and it gets down to zero because of how bad the economy is and how many lenders have to lend to the small number of high balance sheet banks, right?
so these people wanna get it because it's safer to have their money in bonds. Is that it? Is that why they're desperate to get in? I mean, why would they
because they're
do
gonna make
zero?
something. They're gonna make 10 basis points. They're gonna make 30 basis points, something,
Uh-huh.
right? The lenders of the money, if they just sit on their money, they're losing money
Yeah, but you're
because of inflation, debasement of currency.
okay.
The banks don't want to sit on cash.
Okay, it's the banks who are lowering the interest rate.
No, I'm just trying to explain that the banks use the interest rates on the different bonds to offset their own operations.
Right.
Right. So they might they'll lend long term, borrow short term, or vice versa, depending on what they're doing, and they make money on that difference between the different interest rates because they're lending and borrowing, and that difference is where they make their money. So on one end, the government is issuing bonds in order to get revenue in, but on the other end, if the banks are buying the bonds, they have to offset that on the other way by making money, right? So they lend out, so they'll borrow at 5%, lend out at 6%, and to make that 1% difference, right?
I'm with you.
But if there's not enough people to lend to, or they're worried about the economy, then they're not lending out to some guy who wants to start a new business next week. They're not even lending it out to the company who's 5 years old and they're a middling, $100,000 a year business. They don't want to lend out there. They want to lend to Apple because they don't worry that Apple's going to default on that loan. Because Apple's sitting on a bunch of cash, so they're not worried about it. And they'd rather lend it out for 50 basis points profit than to lend it out for theoretically 2% and lose on that bond.
I get it.
But if they feel that way, a bunch of lenders feel that way, which means they have to bid for Apple or whatever large institution to get their bonds. That's why you get low interest rates. One of the reasons you get lower interest rates. So when they say free money, they mean free money to large players who already have a bunch of money. That's what the free money is. Interest rates should be sloping up and to the right. It should be the 2-year is 2% and the 5-year is 4% and the 20-year is 7%. It makes sense in a healthy economy, because in a healthy economy, the money That's the money for the people who would be lending to the government. They're like, well, I don't have to give you my $100,000, my $10 million, whatever. I could go put that inside the economy that's doing very well. I'll make more. That's why interest rates go up in good times, because they're like, well, the government's, yeah, but I really need you to lend me the money. Okay, well, then you got to give me higher interest rates. But here, it's like, well, are the higher interest rates a sign of a good economy?
Right.
Or is it a sign of distrust within the system that they go, well, I don't believe you, government, what you're doing, your shenanigans, your policies make me think that my money's not going to be worth enough 5, 10, 20 years from now. You got to give me more. So what is it? Are 0% interest rates healthy because it causes funding for large growth entities that end up giving us stuff like Amazon and Apple? Or is it healthier to have 5% interest rate because you and I can go get, spend $100,000 to get a bond and get a 5% interest rate, and I don't have to go risk it in the stock market?
Do you want to address this comment from Atheists Don't Exist? Principal payments from agency debt and mortgage-backed securities exceeding $35 billion per month will be reinvested into Treasury securities. Is this something you know about?
Yeah, so I don't know all the details for this. Principal payments from agency debt and mortgage-backed securities exceeding $35 billion. Okay, well, that's good. If it's going to be reinvested back into Treasury securities, I don't know how consistent that's going to be.
Thank you for your comment. Atheists Don't Exist. Appreciate that. Yeah. Well, Tom, so it sounds like you're leading me somewhere here.
Yeah, so I wanted to bring this up. So if we switch back, remember my thesis here is the idea is, hey, maybe the Fed is the one who did this in order to stabilize prices. Let's switch back to cross-border capital, and they tweeted out some time ago this odd thing that's going on where liquidity has suddenly showed up inside of the in money markets. This is funded futures. This is like plays on the interest rate for the Federal Reserve, and you would expect a credit crunch time. You would expect financial conditions to be tight and where liquidity disappears. So, for example, if we go to the NFCI, you'll see here that in times of stress, this is the .com bubble is this gray over here bar. This is the global financial crisis, and this is COVID.
Mhm.
Whenever the financial conditions go up, it means that there's stress within the system, and when they come down, there's less stress within the system. Well, look what happened over the last 2 months. We got this rise up and then boom, which means since April, mid-April, liquidity has been injected back into the markets. So NFCI is showing that financial conditions falling, so becoming easier. In the money markets, liquidity has shown up. And then if we take a look at excess reserves at U.S. banks, that has increased, this is QE.
This is great news.
Well, it depends what you mean by great. It's great in that it'll make Bitcoin rise. That's the other thing. We're seeing Bitcoin hit all-time highs, right? So Bitcoin is hitting all-time highs in the midst of tariffs, trade wars, political turmoil. Bitcoin's rising, excess liquidity up, mystery funder within the market, which means liquidity is being injected.
Oh, baby.
Liquidity is being injected into the markets.
Bullish, baby.
Bullish.
But it means
right?
that the economy is not good. When
Not doing well. Not doing well. Not doing well. Except for the fact that your mom can go and get 4% on her money. Like, this is the part I'm not understanding. It's almost like if someone were to tell me, hey, this thing that we saw here for years, this is the yield curve. Let's go over the week. This is the US. This whole downtrend has been the thing that the Austrian economics have been warning us about this whole time, this deflationary effect, right?
Mm-hmm.
And what the Ron Paul of the world always said is that, well, we're gonna have to pay for our thing. We're gonna have to have more austere measures, increase interest rates, stop doing things all over the world, focus domestically, and get our house in order. And what would that look like? That would look like interest rates going up and
Is that what we're
populism
doing?
and all the stuff Trump is doing, the administration, and reshoring manufacturing and all that, which has a cost, which is higher interest rates. So is this healthy? Because the last time that we had this in the 70s, even though the financial markets suffered, we had one of the biggest growth ever. This is where the baby boomers were coming into the market, inside of they were buying houses, they were getting jobs, and whatnot. Like these were good times economically, but bad times in financial markets. Whereas over the last 40 years, we've had bad times in the economy, but good times in the financial markets. So if you're like, if it's good or bad, I don't know.
Switch it. I'm all for it. Switch it. Flip it. They've had their time. Now it's time for the rest of us, right?
That's right.
And then does AI play a role in this?
It does. I was actually looking for some more evidence to the case, the thesis that the new productivity that the AI is going to generate. You just got to imagine what's going to happen. Let's say the promise is true for AI, and we get a boom of productivity. It's productivity that's not labor driven. So what happens to everybody who has jobs that get replaced by AI? Unemployment, right? That means we have more slack within the labor force, which means more companies can start new businesses and offer less money to employees, right? In order to get them on board. They're just happy to get a job. So you get more companies, more businesses, more opportunities for the business owners. So if you have money and want to start a thing, you get more money out of it. But if you're one of the plebs, what do you do? Like, even the jobs that they're going to hire you for is not to push buttons anymore, because we have the button pusher automation. So it's like, I don't know where they go. Does this Slack end up being a boon for new businesses, or I don't know what that turns into, or how long it takes. So the AI story is not a now story. What is a now story is that there's clearly funding stress within the global financial system, because if we take a look at term premia, let's see if we have it here. 1 second here. If we take a look at term premia, we have here the is this the right one? Yeah, okay. So term premia is the excess interest that you're paying on or the excess interest that a lender is requiring in order to lend money to a government. So here we have the let me expand this image. No, we have the U.S. Treasury. This is the German bond. This is the Japanese bond, the French OAT, and the UK gilt. And we're seeing that if we were to normalize everything and just extract out how much more interest rate are lenders asking on top of the normal interest rate, we're seeing that the U.S. Treasury is still the lowest. So over here, this red, the U.S. Treasury is still considered the best safe haven asset amongst all the other bonds. Right? That's good.
Right.
It means like that. It's good in the sense that America is not losing its dominance, and the empire is still going strong.
Long live the empire.
Yeah. At the same time as the dollar is falling, which I talked about with Mike last week, that what I would expect to see is a pull up of here and a pull back down. That's exactly what's happening with the rise in Bitcoin and a stable in gold. And a bull steepener in bonds. So I don't know.
It-
On paper, without the narrative, it feels like all this is good.
yeah, it's like the end of Deep Impact where, you know, things stabilize, the asteroid is hit.
The waters receded.
That's right.
So we'll see. Anyways, so that's me going waxing on. It's been very interesting. If you're not paying attention to the bond market, like if you're interested in equities, you're paying attention to crypto, you want to add currencies to it, which I think I've made my case over the last couple of months why it's important. But the bond market is the market to pay attention to. It is the thing that funds everything and lets you know when things are going to happen way earlier. Because if you're managing $150 billion in a you need to make decisions all the way up to 20 years, 30 years out.
Right.
And so those moves are precursors for what's going to happen in the future, which is why the yield curve inversion is such a great predictor for when recessions are going to come. Anyways, so interesting. I think the mystery buyer is the Fed. If it is, that means we're going to have a bunch of liquidity up until the point where the cracks are too big to gloss over. And then it's Bitcoin to 40,000, market down 20 to 50%, and recession for the next 5 years. But after that,
Well,
profit.
look, it doesn't really matter if it goes up or down. What matters is if you know it's going to go up or down, because then
That's
you can
right.
make money on it. That's what I'm
That's
learning.
right. That's why it matters. Peter, that's why it matters. We're taking a look at farming futures, the interview with Mike and farming futures, the prop firm trader for who farms and trades. And he says something to the effect of that the people around him don't even know that he trades, really, or how much money he's making, 6 figures regularly trading, or not regularly, but like 6 figures trading, and his neighbors don't know, right? So his regular job is his life is better because of using the markets in order to actually make extra money, and he can actually continue farming and doing the stuff and have less stress and all that. For me, the people who are not using information, not paying attention to the markets, not parlaying that in order to get more funds, it's you're doing yourself a huge disservice, and you're going to end have fun staying poor. Let's just use the Bitcoin line.
And if you're going to be trading, and I think in this world where there's going to be more unemployment, et cetera, you might want to do yourself the favor of adopting automated trading. TradersPost. We're here to help you when the world goes to crap. All right, TradersPost. Automate your trades.
Well, we might as well just lead right into our sponsor then. Our sponsor this week is, of course, TradersPost.
Ask yourself this. Are you making trading harder than it needs to be? If you're trading manually or still coding just to connect to your broker, yeah, it's time to upgrade. TradersPost lets you automate trades using signals from tools like TradingView or TrendSpider or even your own custom setup. It works with brokers like TradeStation, Tradeovate, Coinbase, and a bunch more. I've been using it myself, and getting started was smooth. The platform's clean, setup's quick, and once it's running, it just works. And when you're ready to scale, adding more strategies, plugging into prop firm accounts, or juggling multiple portfolios, TradersPost handles it. It's built to grow with you. Start your free trial at TradersPost.io. Trade smarter, automate your edge.
Welcome back. All right, time for market minutes. There's all kinds of news that happened during the week, and some of them are not big enough to warrant its own blog. So we like to go over it in our market minutes list. This week, Bitcoin surged to record highs, crossed 110,000, reaching all-time highs on May 21st, driven by a 3% rally amid increased investor confidence. I gotta say, I've been predicting 116,000 on Bitcoin. Right, 116,000 on Bitcoin, basically around like nowish. So just remember that your boy Tommy over here, back when Bitcoin was at 74, we were talking about Bitcoin getting up to here in this time frame. Just saying. Just saying. U.S. credit rating downgrades by Moody's. Moody's downgraded the U.S. credit rating from AAA to AA1 on May 16th, citing a $36 trillion debt pile, sparking concerns about potential market volatility, which I don't care about the. I echo what the Treasury Secretary Bissett said. I've never made my decisions based on what Moody says, and downgrading from AAA to AA1. If they said that about my beef, I'd still eat it. So that's not him. That's my quote. I just added that on top of what Bissett said. Stocks flat after tariff threats. Major U.S. stock indexes ended flat to slightly higher on May 19th, despite early losses, as markets reacted to President Trump's latest tariff threats. Gold hits weekly high. Spot gold reached 3,303 on 09, driven by U.S. fiscal instability, a weaker dollar, and global tensions boosting safe haven demand. S&P 500 and NASDAQ volatility. The S&P 500 and NASDAQ composite saw gains earlier in the week, with the S&P 500 climbing 1.67% to 5,375.86 on April 23rd, but faced consolidation pressures later on, which is just amazing, Peter. The bounce from up for the markets to near all-time highs. You go, who could see that coming? Old Tommy boy. Yeah, okay, fine. I was quoting Ken Carson, quoting other people within the markets. But sometimes it takes a aggregator like myself, your very own TradersPost AI, real AI, in order to spoon feed you this information, little baby birds. U.S. S&P Global PMI data release. The release of the U.S. S&P Global Manufacturing and Services PMI data for May on May 22nd influenced market sentiment regarding economic growth. U.S. existing home sales data. April's U.S. existing home sales data released on May 22nd shaped investors' views on the housing markets. Yeah, of course. I should really put the specific numbers in the market minute updates for next time, and I'll be sure to do that. Saylor's Bitcoin purchase. Here we get to the good stuff. Michael Saylor's MicroStrategy purchase. Well, it's not MicroStrategy anymore, right? He just calls it strategy now. They purchased 1.34 billion in Bitcoin, contributing to crypto market bullishness on May 12th.
Does him buying move the price?
Sorry?
Does him buying move the price? How is that bullish?
Yeah, 1.3 billion. That'll move the price a bit.
Oh, all right.
And the idea that he's buying it publicly makes other people buy it. You know how Ponzi schemes work. You don't know how Ponzi schemes work? SEC focuses on crypto regulation. They announced a focus group on crypto rules and sparked discussions about potential impacts on Bitcoin and altcoin markets. Apple iPhone price hikes rumors. Speculation about Apple raising iPhone prices contributed to market movements in tech sector on May 12th. Oh, I didn't put this inside of the market minutes, but apparently I think the gaming consoles, Switch, PS5, and the Xbox Series X and S are going to go up in price or have already gone up in price because of tariffs. It was the first time I've ever been inside a gaming cycle where the consoles are more expensive later on in the cycle than at the beginning. So maybe get on buying whatever video game console. If that's what
do you think the tariff narrative is true, or are they just using it as an opportunity to raise prices?
No, they have to. Video game companies do not want to raise prices.
Right.
In fact, they're the one of the main industries that games were $70 a console when we were kids in the 90s, and they were still $70 up until like before this inflationary thing. They do not want to increase that, especially since they make so much money on loot boxes, software as a service, Xbox Game Pass, all these sort of like Netflix style subscriptions. Right. They don't want to increase the price. Right. But they can't lose too much money on the console. Sorry?
It's like when I worked at the gas, not at the gas station, but at the service, customer service, and they were like, people were calling and complain, like the gas station is raising their prices. The gas station is not making their money off of the gas; they're making their money off of the snacks and foods that's in there. The last thing they want to do is increase the gas. In fact, they want it to be as low as possible. They'll even lower into their margins in order to get you to go buy those chocolate bars in stores.
Absolutely. A weaker dollar impacts portfolios. A weaker U.S. dollar raised concerns for portfolio performance, particularly for investors avoiding dollar-denominated assets. Money Supply and Back in Focus, a new book advocating for... No, I didn't actually want to promote that book. It seemed a little bit too flimsy. So we'll just leave it there for market minutes.
Is this a controversial book that we can't learn about?
If I talk about it, then it'll go up in sales. We have what, 4,000 people watching right now. It'll just be too much. I got to be careful with what I endorse. I'm the guy who called Bitcoin bottom at 74,000. Did you remember?
I've
You hear
heard.
this?
I've heard it.
All right. All right. Well, that's it for this week. Unless you have anything else, Peter, you wanted to point out.
Yeah, I do want to. Did you put the links or whatever you needed to do for the last blueprint? Want to put you on the spot there. Make
I
sure that's there.
didn't. I do
And-
want to do this one small thing for the strategy buy and sell that I want to fix, and then I'll post that online.
Excellent, excellent. Everybody, just pay attention here. We got a new logo that's coming out. So if you start seeing those colors change, it's for good reason. It's for good reason. There's a whole science behind these colors. Tom will talk your ear off if you ask him about it. So please don't. Aside from that, no, I got nothing else.
All right. Well, it's been great. Look, we're traders. We don't just watch the news, we trade it. And it makes us, if there's volatility, if there's trends, if there's edges to find, we're going to do our best to hunt it out. If anything is on your radar, please let us know. You can put it inside the comments or send us a message, tag us on X. We're happy for you to feed the AI algorithm in order to make us more popular. A little bit too transparent? Not transparent enough. All right. That's it. Wish you guys a happy week and happy trading. See ya, folks.